All right, good evening, and thank you so much for attending tonight's webinar on the major financial considerations that US persons face living in Australia. I'm Ashley Murphy, Certified Financial Planner, Accredited Investment Fiduciary, founder and principal of Arete Wealth Strategists. Let us get on with the show. All right, I'm going to put this in presentation view. First of all, I do want to be very clear in saying this presentation does not constitute specific personal financial tax or investment advice. You'd be well advised to seek professional counsel, and all materials here have been sourced from sources we believe to be trustworthy and reliable, but we can't warrant their accuracy. A little bit about me. There's a nice black and white photo from the Financial Planning Association conference in Chicago in 2018. I'm a tri-citizen, so the issues of being a US person have been with me from birth. My mother was American and raised in Brisbane, Australia, moved to the US 15 years ago, started in corporate finance, then saw the light in 2010. I don't know why I ever didn't go straight into personal finance, but I didn't. Studied for the CFA, CFP, had a great introduction to the career, winning all the scholarships there were to win in the Bay Area. I was also a Knowledge Circle host for the FPA for a couple of years. So I've really gotten to learn the ins and outs of this cross-border space. There are a number of different firms that work with Americans abroad, but to my knowledge, mine is the only firm that specializes in working with Australian American expats that's based in the US, and there are a number of great firms in Australia as well that focus on the same thing that I partner with. So really, Arete Wealth Strategists consists of two brands, namely the domestically focused brand Arete Wealth Strategists and Arete Wealth Strategists Australia, both of which are fee only. My firm is a registered investment advisory, meaning we have had a fiduciary obligation from inception. So legally required to put the client's best interests when operating in an advisory capacity. Totally cloud-based. I use the state-of-the-art tech stack for my clients so they're able to securely access their information wherever they happen to be. I offer virtual and in-person service. I visit a number of US cities on a quarterly basis and tend to make it to Australia twice a year. I've got a presence in Minneapolis and San Francisco. Okay, so a little bit more about these two brands here. We're really focused on Australians in the US and returned Aussies or Americans living in Australia who satisfy this wholesale client requirement, which, as ASIC defines it, is $500,000 in investable assets. Arete Wealth Strategists is really focused on US business owners and executives, so therefore I find my sweet spot with Aussie business owners in the US or American executives in Australia. Okay, who are our clients? These would be the issues concerning Americans in Australia. You can see they're on your screen, or Australians living in the US long term, or Australians leaving the US. That's really who we work with. So let me get into an outline of tonight's presentation. We're going to be focusing on a couple of major areas. So banking and investment considerations, including account closures and US investment accounts and how they might be properly allocated. Retirement accounts and distributions, how that works in terms of taxations and the different approaches you might take. Social Security, what eligibility exists for US persons abroad and their spouses and family members. Foreign exchange, we'll talk very briefly on, and there's plenty to be said about taxes. So the annual tax filings required of a US person, determining the foreign earned income and foreign tax credit, US gift and estate taxes, expatriation taxes, otherwise known as the HART Act, and PFIC, Passive Foreign Investment Corporation. So let's get into that. Okay, firstly, there's been a disquieting trend that's been underway for about the past decade now to do with account closures for US persons. And it's come about due to a host of burdensome compliance requirements. these particular requirements have crept up on us over the years, some of which have been around for a lot longer than others, but really there's been a concerted wave of enforcement of these rules. So not necessarily a whole bunch of new rules, but rather enforcement of rules that have been around for a while. And there's been this crescendo of rules and regs that have come together that have really caused major banks and custodians to begin taking notice of what their reporting requirements actually are. These requirements affect bank accounts, retirement accounts, and after-tax investment accounts. So really quite broad in their application. And it's important to know separately, this was what I was alluding to a moment ago, US securities law really dictates that mutual funds cannot be offered for sale outside of the US. Now that doesn't mean that there won't be someone on this presentation that doesn't in fact own a US mutual fund. It's that technically that's not supposed to happen. That doesn't expose the holder of that account to any penalty. It's just not supposed to be the case. So very often if someone is working with a brokerage that is comfortable at working with a US person overseas, they will find they will be unable to put together a mutual fund portfolio or a portfolio that includes any mutual funds. So some of the rules that have come into effect that have caused this attentiveness on behalf of the banks and custodians has been as a result of September 11th. In came the Patriot Act and the Know Your Client rule. This is really intended to police illicit sources of financing. So wanting to make sure that the US knows where money has come from. There, of course, it was FATCA that came about in 2010, and then the further tightening of these laws with the transitioning of the enforcement of these over to the Financial Crimes Enforcement Network. So that's essentially what's happened domestically, and there's been, particularly in Europe, there's been a number of changes that have led to foreign banks enforcing these particular requirements, but that's not our focus here tonight. So the types of restrictions may vary by the firm. We may see an outright closure. I've seen that a lot where particularly former clients of Raymond James, of Morgan Stanley, Merrill Lynch have been told they've got 30 days to liquidate their account, or to move their account, otherwise that's going to be a forced liquidation with severe tax consequences. There's restrictions on mutual funds. This typically happens when a bank or a custodian discovers that there's a non-resident holder of a mutual fund. They will simply prohibit you from any trading activity other than selling. High account minimum balances, and when I say high, I mean very high. We're talking $1 million, $2 million before these banks and custodians see it as a service that they're willing to offer, to provide the appropriate tax reporting to make that particular relationship worthwhile for them. They move accounts to a special group within the firm, and then they in turn can impose their own restrictions. Or another one that I haven't seen myself, but I've heard others in the space report upon, that is restricting activity to only when the client is physically present in the US, which could be very inconvenient. So who are some of the firms participating in these rules? Here is a list right here. Banking, okay, this is another challenge. So we're going to zoom out for a second here, because this presentation is about the challenges that US persons living in Australia face. One of those challenges will certainly be finding a US-based bank that is comfortable knowing that their client is located in Australia. Here's a short list of some of those banks that might be that might be comfortable in dealing with non-resident US persons. Superannuation accounts. Now, this certainly will be the subject of a subsequent webinar. We can go into greater detail about this. And it's very important for me to outline ahead of time and explain that there is no specific law from the US, nor Australia for that matter, that deals with the taxation of this pairwise combination. Essentially, what we have are a number of private letter rulings and occasional announcements that may deal with some tangential element of this broader relationship. So therefore, we're left to rely upon the best judgment and counsel that we've received, typically from CPAs and tax attorneys. There's a variety of opinions out there. We tend to side with the majority, and that is taking a more conservative view, not the most conservative by any means, but certainly not the most aggressive view on how to tax these accounts, or how these accounts are taxed. So really, it boils down to this formula right here. If the employee's contribution is equal to or less than the employer's contribution, then likely the tax treatment of that employee contribution will be granted that of an employee trust. Otherwise, it would be deemed a foreign grantor trust, which would happen in the event that the employee's contribution is greater than 50% of the account balance, which will, of course, bring about that foreign grantor trust tax treatment. And that will almost certainly be the case whenever we see a self-managed super fund. In either instance, it's important to understand that concessional contributions, that is, those contributions in Australia that are tax deductible, are in fact taxable income in the US, because the IRS doesn't recognize that that retirement account as being a foreign qualified retirement account in the first place. So let's talk briefly about foreign grantor trust taxation and what that looks like. So essentially, it's going to mean taxes applied to the income and capital gain. So really everything is just taxed every year with the change in the account values, whether that account is distributed or not. So growing in an accumulation mode, it's subject to ordinary income tax back in the United States. Additional reporting is required with Forms 3520 to identify the specific owner of the foreign trust. And it's important to note that this only applies to the employee contribution, which would be everything in the event of a self-managed super fund, or whatever remainder that may be if someone's super account were to somehow be comprised of more than 50%. I could see that happening in the event that a self-managed super fund were rolled over to a retail fund after some period of having that self-managed super fund and not continuing it. Okay, the slightly better taxation would be available under the employee trust taxation. This is pretty complicated, however, and most CPAs will err on the side of conservatism with this particular judgment. First of which is determining, well, actually, sorry, the determination for whether one is highly compensated or not is a cut and dried determination, starting in the low six figures. So around, it was 120,000 a couple of years ago to find someone as a highly compensated employee. Most Aussies working in the US would certainly fall foul of that one, and whether that plan is discriminatory or not is another factor to consider here. So that is going to determine how that fund is taxed, even as an employee trust. So if you're highly compensated or non-discriminatory, then withdrawals are allocated between previously taxed contributions, which aren't taxed on withdrawals, so it's definitely an advantage right there, and account earnings, which are taxable as withdrawn. But nevertheless, the key benefit that I identify here is the lack of taxation on the accumulation side. It's more when that account is distributed that the tax treatment is not as good as what it would be for a non-US person. And it's important to note, again, this implies the employee trust tax treatment applies only to the employer contributions. And no additional information reporting is required to the IRS, as the super account is considered owned by the employer. Okay, a little bit of good news here to do with super accounts, which I came across recently. This is a release from PricewaterhouseCoopers from 2017, and that was that PFIC reporting is very unlikely to be required for superannuation funds. So erring on the side of caution, that was another reporting requirement and investment requirement that was necessary if one was to be conservative and try and avoid PFIC taxation, which we'll get to later in the presentation. Okay. Continuing on. So next challenge for US persons living in Australia. Are your global holdings allocated appropriately, or are they being duplicated? We created this graphic a little earlier today to help illustrate the point. So what we have here is a fictitious client's overall portfolios in Australia and in the US. I'll get to the US one in just a moment. But what we see here is a joint investment account between Mike and Janet. Mike's super, so Mike is the US person in this scenario, and Janet's superannuation. What we see here is a lack of coordination just on the Australian side of their portfolio. So you can see Mike has got a domestic large cap fund, so does Janet. They're doubling up on the international side too, also on the emerging and also on the real estate, leaving nothing on the domestic fixed income, excuse the typo there, we say 2x domestic fixed income, and nothing on global fixed income. Well, the situation only gets worse when we factor in the American side. But firstly, I just want to make a point here. Investing in a coordinated manner is called householding. So thus we're considering all members of the household, all asset exposures that they have, all accounts they have, and consolidating those positions to avoid duplication and get the appropriate representation of those different asset classes. This gets more complicated when we add in another country and the various investment accounts held there. And so what you see is Mike's holdings. There's another joint investment account which introduces a separate problem for Janet in trying to be a loving husband. Mike here has inadvertently exposed Janet to US reporting, US tax reporting, because it's a joint account. Janet would previously have had no obligation to report on the US side, but now there's a joint investment account which brings her into to the IRS's clutches. And then of course there's Mike's REA. Now what happens here, you'll see there's double up exposure again on the domestic large cap, emerging, and real estate. Global fixed income, for some reason, again, excuse the domestic fixed income typo there, there's zero exposure. But when we bring this all together, how are the global holdings stacked up? Well, we've got no exposure to domestic fixed income anywhere, neither in Australia nor the US. And we could see massive duplication and magnification of exposures when we consolidate this portfolio. And that real estate holding, particularly that Australian real estate holding, really hasn't been serving them well in the past 2 years or so. So this is something that we need to be mindful of, and mitigating this particular risk is fairly complicated unless you're working with specific institutional tools that can actually look into the holdings of a portfolio in Australia, in the US, bring it all together, normalize the currency, so you're looking at a common base currency, and then be able to adjust and rebalance that portfolio appropriately. So that's a challenge. Looking at the next challenge here, what are the tax implications in Australia and the US for distributing 401ks or IRAs, or even Roths? We don't get into Roths so much, but what does it look like? Well, broadly speaking, there's two options, and they would be: you pay tax in Australia, it tends to be preferential. Of course, someone's situation will dictate what the appropriate treatment would be. But the way that we tend to treat that is the ATO considers 401k or IRA to be a foreign trust, similar wording as what the as the vice versa situation. However, generously, the ATO deems the corpus of that trust to be the employer and employer contributions, thus only the growth is taxable. That seems like a better outcome if you're only paying ordinary income tax on those holdings on the repatriation of the US retirement account to Australia. So in this scenario, you're taking a treaty position. So they're saying we're going to pay tax in Australia and not the US, or alternatively, as the situation may dictate, you may pay taxes in the US, and you're going to take one of two approaches there. You could either take that immediately upon your return to Australia, in which case you're going to pay ordinary income tax on that full account distribution. Not a very tax efficient approach, really. It's certainly not tax efficient if you're under age 59 and a half, where you're then subject to a 10% penalty tax. Alternatively, you could wait till you're over 59 and a half and simply pay the ordinary income tax on the full account distribution. You needn't take it all at once either. Who said that we had to liquidate that entire account? You could distribute that over a period of time and potentially do even better on the tax treatment by keeping your US rates down really, really low, but that says nothing about the treatment that you may incur on the Australian side. Indeed, what you may incur throughout the accumulation phase, that is outside of the scope of tonight's presentation. But an interesting question to pose nevertheless. One thing to note that would be beneficial to the US person in Australia is that should you take option 2, that the foreign tax paid may be used to generate a foreign tax credit that could be valuable in the event that you were to subsequently return to the US or have any future US tax obligation. Next topic, but still under the general heading of retirement, we're talking about Social Security here. Are you or your spouse eligible for Social Security? The good news is that Australia and the US have what's called a totalization agreement, and they recognize each other's Social Security taxes. This is really, really beneficial for US persons because unlike the Australian aged pension, which is quite strict in how it's assessed, it's both means, meaning assets, and income tested worldwide. They don't leave too many rocks unturned in determining your eligibility for that. Social Security, on the other hand, is not means nor income tested. And so the taxation of Social Security is somewhat income based, but your eligibility to receive a benefit is not. So thus, what I'm fond of saying, Warren Buffett collects his Social Security check every month. In any event, if you're deemed fully insured for Social Security if you've paid in, or you're deemed to pay in for 40 qualifying quarters. Now, the devil truly is in the detail with what your benefit would be. It's determined, there's a very complex formula for determining that benefit. In the US, you cap out at the maximum benefit this year is, I believe it's 138,000 is when that Social Security tax caps out, and you'd be subject to the maximum benefit. The maximum benefit at your fully insured age, which presently is age 67, is about, give or take $200, about $3,000 a month, which is subject to an 8% increase for every year that you wait until age 70. So that's a pretty good investment return, a guaranteed investment return from the US Treasury if you wait until age 70. There's no benefit paid to you if you live beyond age 70. Thus, the decision rule tends to be if you feel you've got longevity in your genes, that waiting until age 70 would certainly be a good investment move. But of course, as you heard me say in the second page of tonight's presentation, this is not specific advice, this is general advice. Okay, so of course, taking Social Security, you're eligible to take it from age 62, or if you're a widower, you can take it as early as age 60. But that benefit will be reduced, and it will be reduced forever. So if you take it at age 62, then you will forever have that reduced benefit. We've done analyses on these. It tends to be about age 78 that you see a crossover point by which time, had you waited until taking your benefit at age 70, you would receive a greater lifetime payment. So thus, if you think you're going to live beyond age 78, then waiting till 70 presuming you have the means to be able to get by for those 8 years without that additional income, would certainly be beneficial. Important also to make sure you're not subject to the windfall elimination provision nor the government pension offset, which may reduce your benefit. Again, this is the subject of a whole nother webinar. The totalization agreement, which we're referring to as the Social Security agreement up here. Same thing as mentioned on the previous slide, 40 qualifying quarters. Dependents and survivors are not required to meet additional residency tests as a result of this agreement, which is great news. So I have clients that live in Australia. No, the US has this lovely term of art, a non-resident alien to the US, meaning they have no ties to the US whatsoever, but there's one client in particular who is a widow of a US citizen, and she happily receives her Social Security benefit every month. So more detail here, your monthly benefit may be reduced as a result of some other tests. Again, we'll go into that in more detail in a future webinar and white paper for that matter. So foreign exchange, this is really, really simple. I think deceptively simple. Many clients fail to appreciate the thousands of dollars that they're leaving on the table by not executing a systematic and strategic foreign exchange strategy. We did a webinar on this last year. Let me just briefly show you. We've since come up with a template statement of advice on how to go about doing this, but essentially we're looking at the exchange rate ever since it began floating. We did this analysis pulling from the Australian Central Bank, from the RBA, to see what it's been since it floated, the trend line for the past decade, percentage of time it's spent between 70 and 80 cents. So needless to say, where we're at today is quite low, historically low, about 66 cents presently. You can see here, this is a spreadsheet that we've got, and it's saying something I think very important, and that is the difference in what you will receive for your money in the event that you use an inefficient form of currency conversion. So the interbank rate is essentially with no fee applied whatsoever. No spread is the term used there. Getting the best rate available that we know of, which is Interactive Brokers, one of the custodians we use, that's 0.002%. That's not a typo. That's exactly what they charge. So if you're moving 1.4 million, your fee would be $196 plus $2 is their conversion fee. So if you had to pocket $198. The next best alternative, this is a rate that I have negotiated personally with AFEX, 20 basis points, 0.2%, the best you'll find out there. For a retail rate, I should say. The best, of course, is Interactive Brokers, but AFEX is the best for a retail rate. Many people are fond of using OFX or TransferWise. They're typically charging, well, TransferWise certainly charges 0.6, and OFX is somewhere between this negotiator rate with AFEX and TransferWise. But in any event, you see that for large sums of money, what we see here in this column where it says interbank rate, that's the difference over the interbank rate. So if you were paying no fee whatsoever, then that's what that would look like. I see, Amy, there's a question there. I'm just going to hold questions to the end if that's okay, but I look forward to getting to that. And then what we see over here is the difference between IB. So if you're using AFEX compared with IB, it would cost you $1,700 more. TransferWise, you'd be making a non-tax deductible donation to, no worries, Amy. You'd be paying a non-tax deductible donation to TransferWise in the order of $5,600. So the point here is that these are significant sums, and be mindful about how you do foreign exchange. There's a broader strategy that we go into with clients about that. All right, so moving on here, Interactive Brokers, AFEX, TransferWise. Annual tax filings. What are you going to be required to file as a US person abroad? Depending, of course, it always depends on your situation, but most likely these three, if you have investable assets. So we're talking about balances at any point throughout the tax year of greater than 10,000 US dollars, you're having to file an FBAR. Form 8938 threshold is quite a bit higher at $50,000 for that. And PFIC is if you have an after-tax account more than $25,000, invested in exchange-traded funds or managed funds in Australia, then it's going to be subject to PFIC reporting and PFIC taxation, which is not very nice at all. We produce this to contrast, actually summarize the differences between FBAR and Form 8938 reporting, Statement of Foreign Assets. So you can take a look at that. Next is understanding US foreign earned income versus foreign tax credit. So there's a foreign earned income exclusion of up to $107,600 in 2020. Remember, of course, the US follows the tax year, follows the calendar year, unlike Australia where it's 180 degrees, kind of like how several things are run a little bit differently down under. So if you're making $107,600 in US dollars, US adjusted dollars, then they're really not, the IRS is not going to be concerned so much with taxing you. That's been excluded. Above that, however, you would be subject to a foreign tax credit. That conveniently is also pretty simple. The tax treaty exists to avoid double taxation. So US persons are in the unenviable position, higher earning US persons are in the unenviable position where you essentially get to pay either the higher rate of tax, be that what Australia charges or what the US charges. At the federal rate, that's really going to be Australia for a US person. So you're able to capture that tax credit and roll that forward for up to 10 years, which could be beneficial for an executive returning to the US is then able to offset future federal income taxation. You can't claim both, of course, on the same income. So it's either excluded or you can accrue that credit, but not both. It can be carried forward for up to 10 years, as I mentioned. I do feel like restating something here, and that is that the US is the only developed country in the world that practices citizenship-based taxation. Thus, as a result of the savings clause within the double taxation treaty, if you are a US person, and I use the term US person to include green card holders, although anyone resident in Australia, typically for longer than 6 months, is going to forfeit that green card anyway. But a US person is always a US tax resident, whereas Australia practices a tax residency based on your legal residency. So if you're in Australia, you pass one of their 4 tests, then you will be an Australian tax resident. So thus the US citizen, green card holder, will be both an Australian tax resident and a US tax resident, which is how I'm discussing this particular slide and why you're paying the higher of the two, because you're going to be both. Gift taxes. So a US citizen may make a gift to anyone. There's an exclusion for a US citizen's spouse, an unlimited marital deduction. But for anyone else, $15,000 US a year, and there's presently it's $11.4 million lifetime exemption. So pretty high exemption. I'm not too worried about that, but additional tax reporting is required on that. It's also the same for estate taxes, which we'll see in a moment. But this brings up, the account titling bullet point here brings up a point I raised earlier with my point to do with investment accounts being balanced, certainly householded domestically, but also householded and balanced internationally. And that is, one needs to be very careful about account titling so as not to unintentionally encumber their spouse in a horrifically complicated and expensive and time-consuming tax system that is the US, or that the US has. And that goes fairly deeply, to do with house titling, as that may bring up Form 89, or investment property, I should say, Form 8938 responsibilities. It's really comprehensive planning that needs to be done by a professional that understands the situation for both countries. So US federal estate tax really is not a worry for most folks. Higher net worth individuals will be concerned with that. it's an 11.58 million. I said 11.4. I think I was talking 2019 numbers. 11.58 million per individual. 2 US citizens, it's actually portable. So if one spouse weren't to use all of theirs, their $11.58 million exemption, it would roll to their spouse. So then the spouse would have close to, what's that, in excess of 23 million before they're subject to the 40% US estate tax. But let's not get tripped up with the word state and e-state. Keep in mind that the individual states within the United States, some of them do in fact have their own estate tax, such as my home state here of Minnesota, that kicks in at a fairly low level. At I believe it's currently around $2 million. 16% state estate tax will be imposed, and the states are very aggressive about enforcing this because they're all trying to get more money these days. Here's a map here of U.S. states with state or inheritance tax, and heavens forbid both. Okay, U.S. expatriation tax. This is something that would come up, given tonight's webinar is specifically focused on Americans in Australia. This is something that's going to be relevant to the US person who may be considering expatriation from the US. I'm not making one recommendation one way or the other. As you've heard me say a number of times, this is general advice. But if you are considering that, then the 2008 HART Act, of which I did a webinar on last year, is going to be very important. I get a chuckle when I look at this graphic that my assistant Callan located. Because it's not too far from the truth. For higher income earners that fail one of 3 tests, they being, number 1, a global net worth greater than $2 million, and I mean net worth everywhere, including your primary residence. If you've got a net worth greater than $2 million, there's a $700,000+ capital gains exemption, but you are going to be subject to the HART Act. Test number 2 is if you had a US federal tax liability averaged over the last 5 years of greater than, I believe it's $168,000, then you're going to be on the hook for the HART Act as well. Or if you're not in, if your taxes for the last 3 years have not been compliant, then you'll also be subject to the expatriation test. PFIC, moving on to the next challenge that we have here. It's essentially, and I did a webinar on this and have a fact sheet on my website that you can go to, but essentially, if you have more than $25,000 as an individual, $50,000 assuming 2 US citizens living in the US, then you're subject to PFIC reporting. I'll save a very, very long explanation of how that tax treatment works to go and have a look at the other webinar. But essentially the way around this is to invest in individual stocks and bonds. Individual stocks and bonds are not going to fall foul of these PFIC rules. So that wraps up tonight's presentation. I just wanted to make you aware, you can go to my website. We actually just updated, oh gosh, I think it was last week, we've now got the 2020 key financial data sheet available. So on one side we have US data, the other side we've got Australian data. Very helpful little tool for determining your tax obligations in either country. And I wanted to make you aware of an upcoming webinar to do with advanced estate planning topics for Aussie expats living in the US. Goodness me. White papers, the PFIC white paper, Passive Foreign Investment Corporation white paper is up. And we're getting very close to finally publishing pros and cons of managed fund investing in Australia versus the US. That really brings us to a call to action. If you feel as though your situation may warrant professional assistance, I'd encourage you to reach out. Click on that Contact Us button in the top right-hand corner of our website, arete-wa.com. And we'd be happy to speak with you. We have recently revised our business model. We now work on a quarterly service package structure, whereby well, probably best I go into that in more detail if you feel your situation does warrant a conversation. But anyway, thank you for joining me for tonight's presentation. I do want to open up the floor for questions. There is a special box here, Q&A question. Thank you, Kathleen. I appreciate it. Thank you very much, Ashley. I have converted my 401k and IRAs to Roths. Oh dear. The conversion was included as my global taxable income in the years in which the conversions took place, and the proper taxes were paid. When I'm 15 and a half, I plan to bring the Roth IRAs from the US to Australia. What will the tax treatment be that day, if that day was today? Actually, I feel I can answer that. Do I have to claim the money in any tax return? This is one of those situations, Kathleen. Where I wish the situation were different. You know, you did that conversion, you paid that money. If we go back in the slides here and we talk about the tax treatment of the retirement accounts, there's the two methods you may recall: take the tax treaty position and pay the tax in Australia, or pay it in the US. Unfortunately, Roths are to the best of my knowledge excluded from that, whereby a Roth would be deemed in the same way as a traditional IRA or a 401k, be deemed a foreign trust, and the growth is taxable. So you get to pay tax a second time, but this time to the ATO. That is my understanding, and I'm pretty confident of that. I've seen opinions written by tax attorneys dealing with that exact situation, but I would encourage you to engage a tax attorney on that question, because, as I mentioned, this is general advice and not specific. But I hope that gives you some indication of how the ATO would treat that. Yeah, it is a bummer. I'm sorry about that. Mark Bell writes, "Hi Ashley, if you renounce US citizenship, are you still eligible for Social Security payment?" Yes, that one's easy. Yep, you are. Social Security, you know, there's a reason why it's headed towards insolvency in the late or early 2030s, and I don't expect that'll happen, by the way. I think there'll be some modifications that will come. There's a range of possibilities that they may impose. So I say that tongue in cheek. I don't mean to cause light, you know, on a situation that may affect some people seriously, but it is kind of silly. Even if you relinquish your US citizenship, if you are fully insured, then you will still get your benefit. All right, waiting for other questions to show up. I'll give that another minute before we call it full time. And when I say a minute, I think I mean a New York minute. If nothing else shows up, then we'll call it a night. Amy, okay. Thanks for the information. We'll have a look at the website for details. Thank you very much. Yep, please do. You're welcome to, of course. This is going to be made available on YouTube. The benefit of attending this is that you're able to ask questions that would otherwise not go answered. But two more, I think that maybe when I began the countdown, suddenly people got their questions out. From Daniel Sorvik, we have, if I've been out of the country for more than 10 years, I'm no longer subject to state tax, right? Fellow Minnesotan here. All right, well, I've got a soft spot for a fellow Minnesotan. Of course, facts and circumstances will dictate. I would find it very difficult to imagine how the Franchise Tax Board of Minnesota would possibly classify you as a resident here if you've been out for 10 plus years, and if your primary abode is overseas. There's a whole fact pattern that they're looking for. Where is your gym? Where is your church? Where is your car registered? Or where do you own cars? Sorry, you have a tough time registering a US car in Australia. A whole fact pattern. So I'm thinking that you're probably in the clear there, but it wouldn't hurt to look at, you know, what ties you might have to Minnesota. Ian Robinson asks, do the banks and brokerages close accounts after you have changed tax residency? Yes, they do. However, the question would then become, how do they know that you've changed tax residency? The IRS would be hip to that, because there's a lot of common reporting standards, CRS. There's a lot of information that's shared between governments. But the banks and brokerages mightn't necessarily know that you've moved. Some of them, it's impossible to generalize, to be honest, because some of them are very aggressive in enforcing this. They are very, very, very serious about their compliance, and so they'll have they'll track where your IP address is. If you're logging in from Australia and they don't work with Australia for whatever reason, then they might kick you off their platform. So that it really is a case-by-case kind of basis. Stuart Fern writes, on expat in Australia, how is it best to move money back to the US? That's a great question. And you would do well, Stuart. You're in luck, actually, because I did a whole webinar where I devoted half an hour to answering that exact question. And in brief, I would say it boils down to a couple of things, a couple rules of thumb. That would include, and thank you, Daniel. Thank you for the thank you. My 4 rules of thumb would be find the lowest spread. 2, I'd be watching that pairwise currency, know when the rate's good. At the beginning of the year, the hairs on the back of my neck stood up, and I said, "Wow, 70 cents. This is pretty good." I'm not especially confident with this pairwise direction for a whole host of reasons that I go into in that webinar. So let's get busy and let's see if we can maybe move a bit more money right now for clients in that situation. Next would be a systematic withdrawal schedule. So no one knows the future. No one has a crystal ball. I could be completely wrong about my direction of where I think that currency is going. And as a sort of gesture of modesty, what I advise clients do is to let's set a target rate where we think the number's pretty good. Maybe we'll convert a disproportionate amount when the rate hits that. But otherwise, we'll play it conservative and we'll operate on a systematic schedule and convert a proportion every quarter, let's say. Daniel Green asks, do you suggest foreign exchange hedging strategies to take advantage of today's low exchange rate compared to contemplating a move in Australia 2 to 3 years' time? Great question, Colin. It's hard to say, you know, and it's a very good question at that. 66 cents, kind of going back to that statement of advice, it is a historically low rate if we consider where that rate's been over time. You can see the vast majority of the time the rate has been between 70 and 80. So we're in this territory right here. Where might it go? How low might it go? I don't know. But I'm not especially optimistic on the Australian situation. What would it cost you to hedge that right now? Depends on the strategy that you employ. We advise clients on what are called costless collars, which are not entirely costless given that the proceeds from the sale of a call option that's actually taxable income. So you'd owe some tax on that side of a hedging strategy, but that would greatly subsidize the cost of a put. It might be something to consider. Of course, that's something I'd go into far greater detail with a client. Next, Ian is asking again a similar question. How would you best move accumulated money from US accounts back to Australia? Little each year, all at once. That was the next bullet point that I had there, is the systematic conversion schedules. I think I would be upping my numbers, the percentage of the amount that I would be transferring right now, just based on this. I mean, let's look at the mean. The mean's coming in right around here, 75 cents. Historically, going back, what is this, 37 years. So to be down here, just in terms of standard distributions, standard deviations, excuse me, it looks like it is a notable deviation. And I'm just going to answer that from a statistical point of view. It is a very good rate, and I'm pleased to be traveling to Australia next week where it's going to be that little bit cheaper. Of course, my Aussie friends and family are on the other side of that, so I'm mindful of that. Kathleen Grassi asks, any webinars for estate distribution pitfalls for US parents who may be willing their estates to expats in Australia? That is indeed the topic of an upcoming one. That's going to be the advanced estate planning. The other estate planning webinar is pretty straightforward, and I'm not going to take a stab at that question. Thank you, everyone, for attending the webinar tonight. Really appreciate it. Please, if you encounter anyone you know on forums or in real life, IRL as the abbreviation has become, please don't keep me a secret. To my knowledge, I'm the only US-based advisor working with Aussie expats in the US and American expats in Australia. Thank you very much, and I wish you the best.